Hello, everyone, and welcome to another Wall Street from Main Street podcast. Today, we're going to be featuring Robert Rapier of the Consumer Energy Report. Robert, welcome to the podcast.
Thanks, John.
All right, first topic I wanted to talk about was I've been listening to a lot of people. The most famous guy was Porter Stansberry. They were talking about an oil revolution. They're saying basically massive production is going to happen due to a credit expansion, and that I would say a couple of years ago they said the credit they could get was unlimited, so they could drill and drill and drill. And they said because of the Shale oil revolution, production is going to massively increase, and oil is going to go down to around $40 a barrel. I was wondering what you thought on that, and two, what are Shale production costs? Because from my research, if it even goes below 60, or even goes to 60, all the Shale oil would just be taken offline. It's uneconomic.
Yeah, that's correct. I mean, production costs are probably average around $70. Some of the marginal barrels are probably around 90. So, you know, as the price falls, that's exactly what will happen. It's exactly what's happened with natural gas. As natural gas prices fell, the number of rigs drilling for natural gas fell. I mean, in 2008, when natural gas prices spiked so high, the rig count for natural gas went to 1,600. And lately, it has fallen to 400. So dramatic plunge in the number of rigs for natural gas service, and they've been redeployed into oil. And so it is true, we will, I think, continue to see an increase in oil production, but, you know, we've seen this over the past few years, and what that fails to look at is the demand side of the equation. So even if supply is increasing, if demand is increasing just as quickly, prices won't be able to collapse. And this is exactly what we've seen over the past decade. Demand in developing countries has gone up double digits. And so we've increased oil production a lot in the last 10 years, and oil prices have increased a lot. So there's more to it than just increasing oil production.
Yeah, I definitely agree. And from what I've read also is that sometimes the oil's there. It's just not economical, so we have to wait till prices rise to increase production. Is that what you see?
Yeah, absolutely. I mean, the amount of oil we produce is a function of price. If oil prices sustained at $200 a barrel, we'd be producing more oil because there's oil that's just, costs $120, $150 a barrel to produce. And that's what we'll see. We'll continue to see production go up as prices go up. Right now, we're in a pretty good spot where production has kind of caught up with demand, and so we're seeing a little bit of softness in the oil markets. If that goes on for very long, you will see some of those $90, $100 producers shutting in some of that production.
All right, I want to switch over to the rigs, and as you can see, the number of rigs are natural gas are switching to oil. Why would you say that? Well, I think it's price. Natural gas's prices have collapsed and really stayed there, and oil's been steadily rising. What are you seeing, or can you add to that?
That's correct. I mean, what happened was the number of rigs for both oil and natural gas increased pretty sharply as prices ran up in 2008. But from the second half of 2008, natural gas prices collapsed and oil prices collapsed. But oil prices recovered and natural gas prices didn't. So the number of rigs peaked in 2008 for natural gas and they started to fall. They also fell for oil, but then as oil prices came back up, the number of rigs for drilling for oil went up pretty sharply. And right now it's over 1,400 rigs drilling for oil, when at the end of 2008 it was about 200.
All right, and this brings me to my next topic is you subscribe to a theory of peak light. I'm assuming based on just our recent conversation in this interview that the reason that it could be not complete peak oil is because we do increase production. So do you think also that as oil prices rise and production increases, more oil comes into the market? Do you also think besides the peak light that also contributes to some of the volatility in the oil market?
Yeah, I mean, what contributes to volatility is the decrease in spare capacity. And so a decade ago we had a lot of spare capacity, but then production grew more slowly than demand grew. And so when I was having these debates about timing of peak oil with a lot of people in 2005, I thought, what does peak oil really mean? What happens when oil production peaks? There is not enough supply to meet demand at current prices, and so prices rise. But then I got to thinking, well, that's also what happens when spare capacity disappears. When spare capacity disappears, there is no longer enough supply at, say, $20. So oil price starts to go up. And I saw that this could function effectively like a peak oil scenario, and what people foresaw as a peak oil scenario. As long as demand keeps growing, and you know demand is down in the U.S. and in the European Union over the past few years, but global demand is up because the countries in Asia Pacific and in the Middle East, South America, Africa, their increase was quite more than our decrease. And so people in the United States don't understand, why are we still paying these high prices for oil and gasoline when we've reduced our demand? Well, the reason is the rest of the world took up the slack. And so when that happens, we've got this scenario which I referred to as peak light, where production is actually increasing, but so is price, because the demand is just increasing as quickly as production increases.
Yeah, I definitely see that. And what also I think the biggest misconception out there is you see, I remember listening to Bill O'Reilly one night, and he was saying supply, we have an excess of supply because of our inventories, and demand is low. Why are we paying for this? And people forget, you know, the oil market's a global market. You can't, the U.S. used to control most of the supply and demand. Well, I don't know about supply so much in the 80s, but the demand side, they controlled most of the time. And now, with the rising demand everywhere else, we can still have high gas prices in in a bad economic environment. And I also wanted to get your thought on this, is what people forget also is right now we have $85 oil, and they're worried about the slowing down in China. The European debt crisis is priced in, and bad economic growth in the U.S. Can you only imagine what type of oil prices we would get if China's economy was firing on all cylinders, the European debt crisis was resolved, and the U.S. economy was in an actual recovery? Don't you think that's sort of lost in the equation, or not talked about?
What always happens, and this gets into another hypothesis that I put forward, and that was the long recession. And historically, what happens when demand for oil is high, oil prices are high. And then that slows down economies, and when economies slow down, that decreases demand for oil. And so that causes prices to collapse, and that leads to recovery. So what happens if demand continues to increase even as prices increase? And so you've got Western countries that are in recession, or at least economic slowdown, which normally the United States was such an important consumer of oil that when demand fell sharply in the U.S., that affected global prices. And so what's happening now is, because all these other countries are picking up the slack in demand, we didn't have the price collapse that we normally had. I mean, it did briefly collapse in 2008, but that wasn't sustainable, and so it came back up. And so we have not had a collapse that allows us to come out of this recession. And so I thought, you know, if oil prices did go down a little bit and we began to recover, well, then our demand goes up. So what's waiting after the recession is more recession. And I said, you know, after Jim Kunstler's The Long Emergency, I coined that the long recession, the recession that never ends because prices can never collapse, because demand never collapses, or because production can't build out enough spare capacity for prices to collapse.
All right, and my next subject I wanted to talk about, because you have such a great background in chemical engineering, was a lot of people, you know, some analysts I didn't talk to, but I follow, talk about if you really love technology, the oil sector is where you'd want to invest. Do you see any, what do you see for the oil technological sector?
Yeah, it's been quite interesting over the past, say, decade, because technology developments in fracking are what opened up all this new natural gas and all this new oil production. And this was not foreseen by very many people a decade ago. And so, oil companies are always investing in technology. And, it was always known that this oil was there. The Bakken oil was known. It was very difficult to get that oil out. And so these developments in fracking technology increased the size of the oil reserves in the United States by quite a bit because it made that oil suddenly economical to produce. And so oil companies will continue to push technology. Some of them are looking at methane hydrates, which is like methane ice that's underneath the ocean. There's more of that than there is conventional gas in the world, and Japan is very interested in that, obviously, because of their issues with nuclear power. They would love to be able to get their own natural gas, and they have it there. It's on the ocean floor. They can never figure out how to economically harvest it.
All right, that actually must be really high cost of production, because I see in Japan, at least last time I checked, it was around $18 per British thermal unit. What are the costs around there of production for the natural gas in Japan?
There is none. There is no natural gas production in Japan, and so back oil is a global market. Natural gas isn't so much a global market, and so this is why we see the price it's referred to, $18 in Japan, and we're $3 or less in the United States, because we don't have the ability yet to get that natural gas out onto the world market. And so you see huge discrepancies. The cost to produce in the Middle East is quite low, but then the cost to build LNG terminals and to ship the stuff gets quite high, and so you end up putting it into countries like Japan at quite a higher price than probably an order of magnitude higher than it costs to actually produce the gas.
All right, and speaking of gas, you wrote this, I would say, 2 weeks ago in your newsletter for the Consumer Energy Report, is that we can get gas from air. Can you explain that to our audience?
Yes, a British company called Air Fuel Synthesis made an announcement a couple of weeks ago that we're producing gasoline literally from thin air. And what they do is they extract the carbon out of carbon dioxide, and they take water and they electrolyze the water, produce hydrogen and oxygen, and from those raw materials they make gasoline. And so the first question is that realistic? And the answer is yes. I mean, you could take those same raw materials and you could make all sorts of things. I mean, you could make plastics and carpet and paints and medicines, because all the ingredients are there. The problem is the second law of thermodynamics always says that it will take more energy to take carbon dioxide to a fuel than you will ever get from burning that fuel. And so that's very important, because that says we won't actually produce a lot of fuel from air because the energy cost will simply be too high. That's how I also say, people ask me these water car commercials and ads that people hype, is that real? I said, yes, you can actually run a car on water, but what's lost in that equation is you must have higher energy inputs that water down into hydrogen and oxygen before you can do that. And those inputs are not ever counted in that equation. And so it's probably not to try to run a car off of water, simply because the energy inputs will be greater than the gasoline you had to put in to run it. So just a consequence of the second law of thermodynamics, you burn fuel and you make carbon dioxide, you release an amount of energy to take it back to fuel from carbon dioxide. Always requires more energy than you got from burning it.
All right, that's pretty interesting. And if our audience wanted to find out more about you, how can they do so?
It's if you Google my name, I think most of the sites that I write for are pretty high up on the page. I write for Consumer Energy Report. I'm managing editor there. I write the Energy Strategist, which is an investment newsletter. Write a lot of different columns end up in Christian Science Monitor and Washington Post and Forbes and so forth. So pretty easy to find me, but my home for most of my columns is Consumer Energy Report.
All right, thank you. And I just want to say I love the Consumer Energy Report newsletter. There's always something new every week that I've never even heard of, so I strongly recommend it. And look forward to having you back on in the future.
All right, thanks a lot, John.